Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. I'm chatting with Elana Nel, fiduciary specialist at 91. Elana, appreciate the time. Talking foreign trusts, and I stress the foreign part here. I suppose before we delve into some details, the thinking behind a foreign trust really is around tax planning and ultimately estate planning.
Simon, that is correct. I think often there's a misconception that it's all about tax. And really, it's obviously important and it should be considered and the client should understand it. But it should also be about more than that. It should really be about estate planning and looking after the next generation and setting up a structure that's got a really long-term benefit for the whole family.
I get your point. Now, I want to delve into that long-term and the family part of it. But before I do, a lot of folks think, foreign trusts, if you're a billionaire, absolutely. But these days, the ease of my having offshore assets has become so much easier that I suspect that this is not just for the ultra-high net worth individuals. This is a serious consideration for people who are investing overseas, which most of us will be doing, increasing values.
Yes, I agree. I think the fact that so many people are investing offshore in any event, as you say, and that your mechanisms to be able to do that have become so much, easier and the values have increased so much. It's really opened up foreign trust to more people. But I think we still need to accept that there is a certain quantum that we need to have to make it worth your while. A foreign trust can be an expensive vehicle. There's setup costs, there's trustee fees, there's trust administration fees, and, it needs to be worth your while in the end of the day. Absolutely.
The fees are an important point. Is there, you say a quantum, is there a magic number? Is it, if you've got, is it $1 million offshore or 10 million? Is there a number at which it's a case of, get phoning quick?
Not necessarily a fixed number. I think there's a few things which plays a role. So, how you're going to fund the trust will determine whether you, for example, if you're funding it via a loan from South Africa, you need to charge interest on that loan and you're going to be paying tax on the interest that you earn. So that's let's call it an indirect further cost, which means you need a little bit more funds to make it worth your while. But if there's going to be an inheritance, maybe, from a non-resident or a family member, or you may know about the ability for South African trust to make distributions now to foreign trust. If you're funding it that way and you don't have that loan cost associated, then immediately the value can be a little bit lower.
Yeah.
And I think the other consideration is, is it a once-off lump sum? You've sold your business and this is the amount that you have? Or are you able to add to it over time? So yes, you may start at a $1 million level now, but over time you're going to be adding to it. That will also make a lot of sense.
And talking there, because of course how we fund the trust matters. We can do donations, but donations are capped at, in South African tax law, 150,000 per person per year. A lot of it is going to be via that loan structure, I imagine.
Yes. So remember, you can donate a lot more than the 150, but then you're paying donations tax at the very high levels. So it's been very common for South Africans to have to fund the trust via a loan. And as I've said, the newest method is if you have funds that's been building up in your local South African trust and certain requirements are met, then you could potentially make a distribution from the South African trust to the foreign trust.
Oh, gotcha.
As well.
Yeah, hadn't thought of that. Of course. You mentioned generational right up front. And as I said, a trust, yes, there's tax issues, there's estate planning. That estate planning then perfectly sort of blends into the generational issue here. And that, I suspect, it might be a secondary plan up front, but I think the generational becomes a lot more important as time moves on for many of these trusts.
Yes, definitely. To have the ability that your beneficiary can receive distribution from a foreign trust to take care of their education one day, even overseas education, or to set them up, in a property, to set them up by buying a business. It's really, not just children, you're thinking grandchildren and generations after that. And, even where your loan funding or your funding is via a loan, there's also then decisions that you need to make in terms of your will, how you would deal with that loan asset, which you will own at the time of your death. And if the loan is bequeathed to the trustees of that trust, that will mean that there's significant or could be significant capital in that trust, which is also very beneficial when it gets distributed to the South African beneficiaries in future.
Gotcha. And does a trust protect the assets against sort of things that are going to happen to us? I'm thinking perhaps insolvency, perhaps creditors, perhaps just bad spending habits. To be clear, some of us are people and human nature. The trust kind of protects generationally against that as well.
Absolutely. So if you think, what's the alternative? The alternative is I bequeath my assets to my children, who bequeath those assets to their children one day, and they all own it personally. And, there could be claims against those funds, or they could spend it during their lifetime. Whereas if it's in a foreign trust managed by professional foreign trustees who need to utilize those funds and look after it for the benefit of the beneficiaries, it is much better controlled in terms of protecting the beneficiary against all of those life risks, to call it that.
Life risk. I like that as a phrase. A practical question, which I think is going to open a bit of in terms of distributions. I mean, ultimately, we want to take some money out of the trust, not in terms of collapsing it, but, we take money out. This is the purpose of the trust. How is those distributions? How are they taxed for the individual?
So for the South African tax resident beneficiary, it will depend on what is the nature or the source of that distribution. So if it's from actual capital, so for example, there was an inheritance that went into the trust or a capital distribution, that can always come out as capital distributions, which does not have any tax implication for the beneficiary. But if, for example, the whole trust was funded by a loan from South Africa, then you can repay that loan, obviously also tax-free, but anything else, so be that accumulated income or accumulated capital gains or current year income or current year capital gains, if that gets distributed, it retains its nature for the beneficiary. So if it's a capital gain, the beneficiary will be taxed in South Africa at the maximum or up to the maximum of 18%. Or if it's a rental income from an overseas property, that will be at marginal tax rate. And if it's a foreign dividend that gets distributed, it will be at the reduced 20% rate.
Gotcha. Okay. Perhaps not as complicated as I thought. A last question. We've touched on costs, but perhaps and many of the importances. One of the big points I think folks do have to understand is that you really are giving up control of those assets. And, in many cases, particularly if it's investments and the like, you've probably got investment managers. But that is an important consideration that someone needs to take into account.
Absolutely. I think it's vital that people understand that once you've given the funds, be that via distribution or inheritance or loan to the trust, it now belongs to the trustees to look after it for the benefit of the beneficiaries. And you no longer can give any instructions or make any demands. So where you utilize loan funding, you obviously still retain that loan asset and you can recall your loan or ask for repayment according to the terms of your loan agreement, which will be in place. But apart from that, you absolutely need to realize that you've given control away. And, that is sometimes, a big thing for clients to consider and get their heads around.
Yeah. And for many, I'm sure it's like it actually just makes their life easier. But for some, I think that might be a hard step. We'll leave it there. That's Elana Nel, fiduciary specialist, 91. Appreciate the time. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions.